Welcome to our 9th annual Economic Outlook. Thank you for joining us today. I'm Phil Busenitz, one of the strategic, smart, and wonderfully human professionals here at Matthews, Carter & Boyce, CPAs in Fairfax, Virginia. I'm usually a bit more modest in describing myself, but in December, MCB launched a new website and a more modern visual representation of who we are. A sophisticated, adept, highly skilled team with a strategic approach to business that is warm, welcoming, and personable. We hope that you like our new look and the color orange. For the past 75 years, MCB has been honored to be a trusted guide, providing sophisticated business advisory services, audit and assurance, tax planning and compliance, outsourced accounting, and employee benefit plan consulting. We've earned a reputation for doing more than just keeping the books and have become known as strong, proactive partners dedicated to our clients, employees, and community alike, and who invest in helping each adapt and grow. Each January for the past 9 years, MCB has been hosting this complimentary event for our friends and clients, featuring renowned economist Dr. Terry Clower, sharing his annual economic outlook to supply insight into your business planning. With so much uncertainty in the US and local economies, Dr. Clower will shed light in key areas where business leaders may want to focus their attention in 2023. I should add that we invited CNBC to be here today, but they were busy covering a different gathering of business leaders in Davos. Before I turn this over to Dr. Clower, a few housekeeping items. The presentation and Q&A are scheduled for 90 minutes. Please submit questions via the chat feature, and Dr. Clower will address them at the end of his presentation. Thank you to those of you who submitted questions in advance. Once we finish the moderated Q&A, we will invite you to use the raise hand feature and unmute yourself so you can ask questions directly to Dr. Clower, time permitting. In the coming weeks, we will send an email to all registrants with a link to a recording of today's presentation. Our esteemed presenter today is Dr. Terry Clower. Dr. Clower is the Northern Virginia Chair and Professor of Public Policy at George Mason University. He is also the director of GMU's Center for Regional Analysis. The center provides economic and public policy research services to local governments and businesses, primarily located in the Washington, D.C. metro area. Today, Dr. Clower will provide us with insights into economic trends in Northern Virginia, the greater Washington, D.C. area, and across the country. Now, it is my pleasure to turn the presentation over to Dr. Terry Clower.
Thanks very much, Phil. Appreciate it, and welcome all of you. It's certainly, we are still operating in this new reality of doing Zoom meetings and things. But I tell you, I don't know about you guys, but I've gotten very used to the convenience of not having to drive around town, because remember that we're in the DC region, and therefore there are times of the day when you just can't get there from here. It's just the way it goes. One thing I want to share with you guys real quickly is a little bit of news about the Center for Regional Analysis. Effective late last year, we now have incorporated the Stephen Fuller Institute as a part of CRA. So just expanding our capabilities and bringing together two of our key research centers. Jumping right in, though, into our topics today. We're going to start with talking about the national economy, as we usually do. Gross domestic product is continuing its recovery. You can imagine a little bit of a trend line running along there and think that, you know, we were kind of getting back to trend line, if you will, maybe not all the way back to where we would if the pandemic had never happened, but we were getting pretty close. And then in the first 2 quarters of this year, we actually had a slowdown. So therefore, the newspapers and a lot of pundits and everybody started talking about, we are already in recession. Well, I don't think that that is true. And keeping in mind, we don't know yet, because the group, the National Bureau of Economic Research, that decides when we go into recessions, they always do it in hindsight. So at some point in the future, they may say, oh, by the way, we entered recession back in the first quarter of 2022, and it ended sometime later, you know. But we are not quite there. So the common definition that you hear a lot of times in the media is that a recession happens when you have at least two quarters of negative growth in GDP. That's not exactly the way they do it. The measures that we use, they look at some key factors. First of all, how deep is it? How deep is the downturn? how wide is it in the sense of number of sectors of the economy that get covered, and then how long does it last? And it's all kind of, it's a little wishy-washy, to be frank about it. But there were some underlying factors. So that drop that we saw in the first quarter of the year was about 0.6% on an annualized basis. Every bit of that drop can be explained by accounting adjustments that you do because of balance of trade. So we saw a surge in imports versus exports in the first quarter of last year, and that caused our overall GDP numbers to go negative. In that sense. So it was about I think if I recall correctly, about 2.3% of downturn in GDP that was a trade adjustment. And the same thing, though, to a lesser extent in second quarter. There were some trade adjustments in there. So it wasn't like the economy contracted. And if you think about it, we were continuing to see job growth throughout that period of time. The third quarter of the year actually grew at 3.2%. And again, that was, there was some balance of trade contributing to that, but it was a sign that the economy actually was showing more resilience than some had thought. And of course, the scale of this chart is going to be really screwed up for another several years because of that extreme drop that we saw when we had the shutdown caused by the pandemic. Nationally, we have recovered in terms of employment growth. But even if you think about it, and we'll talk more about the Fed interventions and all, raising interest rates, trying to control inflation, trying to slow the economy down. And of course, so far, at least through our employment data, we're seeing announcements, about big layoffs in tech firms. But by and large, December's, the difference of job growth in November, December at 223,000 is pretty damn solid, right? And so it's not like you've seen it appear in the job market so far, though we are seeing more of these tech sector slowdowns. We'll talk more about that in a little bit, but just keep it in mind, many of these companies that are now laying off 8,000, 10,000, workers or so, that is a fraction of what they have added in the last 3 years. So they expanded greatly, and they overexpanded is what they did. And I've got some charts that we'll talk about how that works. Unemployment, after having spiked up, has dropped down. You'll note that there are, for those of you that have seen the presentation before, we've got 3 different numbers we're reporting here. The UR unemployment rate, which is also called the U3 rate, that is the headline number that we see, and that has dropped back down to about 3.5%. I mean, keeping in mind, historically, that's a very low unemployment rate for the nation. The number that you see there, the U6 rate, 6.5%, includes those folks that are, in the sense, underemployed, in that they're maybe part-time workers and they'd rather have full-time jobs. That number has actually been dropping faster than the other, and we're getting closer to the ratio that you would have seen prior to the pandemic on that. The more important number here, though, for our discussions today, and for you to keep in mind, something that many of you are experiencing, that, yeah, the job market may show some signs of tightening, but I still have labor availability problems. The labor force participation rate, of course, dropped dramatically, but you look at what it's done in this year, and it's basically kind of trading in a range. We're not having a breakback. We are still down a good bit. And that really matters. And if you think about it, that number probably represents, a couple of million workers. So it's about 2.5 million or so, give or take. And so that's a lot of employees. One of the things that we're seeing as an impact of that is a differential impact. A lot of the workers who lost their jobs in hospitality, leisure, some of those kind of industries, simply have not come back to the workforce. And there are several different reasons why. There was, for a while, the political narrative that it was because we had expanded unemployment benefits, but there is now, we have other factors that are impacting that. For example, a lack of availability of affordable childcare, a lack of availability of elder care. We have people who are not participating in the workforce. And in fact, as we've said before in these sessions last year, this is very much turned into a downturn that has been disproportionately affected to the female workforce who are having, who still in our society have more family care, child care responsibilities. Taking a look at the industries by the job change by industry over the last 12 months for the most recent day for December, you'll note that there's two numbers here. The number shows the change. The one in the red box compares February of 2020, so just prior to the pandemic, to what we're doing now. So education and health services, that's private education, by the way, have grown back and again are actually above what we were seeing before the pandemic. Same thing with professional business services. State and local government is still down. Leisure and hospitality is still down by 860,000. So we've seen a lot of recovery, but that in particularly travel tourism, but it's been the tourism piece of it. Business travel is still down a good bit, and that's particularly impacting the District of Columbia. And we'll talk more about that later. Retail trade has rebounded, pretty much manufacturing has rebounded. The one other, you have some other services which are more like building services, and we'll talk a little bit more about this, have been down somewhat. But again, what we're seeing is largely still a recovery. Earnings, a different thing. Earnings have increased, but that bottom line that adjusts for inflation shows a decrease. Our workers are losing ground. This is continuing because of a low unemployment rate to put upward pressures on wages. And that means that the Fed is having a tougher time in slowing down inflation because, let's face it, rising wages is inflationary. So it's kind of one of the things that the trigger that they keep pulling about raising interest rates is not having that effect yet. But as we have said before, a key thing to, historically speaking, when the Fed starts changing interest rates to adjust the economy, there is a lag of anywhere from a year to 18 months. And that's been one of our real things that we've been concerned about, is they continue to raise interest rates before we've really seen the impacts of those first increases that they did several months ago, in fact, quickly approaching a year ago. I think it's really interesting in this chart. So that's a long line. You see that little bump there about 2020. What that is an artifact that most of the jobs that were actually lost during the pandemic were relatively lower wage jobs. And so you're just seeing that caused average weekly earnings to go up. Oh, and by the way, just for your information, the difference between hourly and weekly earnings is the weekly earnings takes into account how many hours you're working, not just what you're paid per hour. So that's my preferred measure of understanding what's truly happening in the economy and the labor market. But as you can see, we're still losing ground, creating upward pressures on wages. This one is a real concern, but there's a couple of caveats. Labor productivity has gone negative. Some of that is a little bit of a slowing of the economy, but I'll be honest with you that I'm having less confidence about the way we measure productivity and whether or not it's kept up with technological change in the way we do business. Now, more Zoom meetings, a lot of things that are changing rapidly. And so I'm wondering about this, but a part of that also could be a little bit of a rebound. You see how productivity spiked during the pandemic? Well, that was like a lot of businesses, people were being, you had a situation where it wasn't a matter of layoffs, but business was growing faster than what most companies could onboard new people, a scarcity of labor, right? So that was causing that to spike. So some of this may be just about a little bit of a pullback that's taken us back to a more normal time. Excuse me for a second. Whatever's in the air today has my voice going a little bit. Consumer confidence, it's a really weird story we have coming in here, where the present situation obviously took a big dip, has come back not to pre-pandemic levels, but is kind of stabilizing out. But you'll note that the expectation index, as the inflation really started to kick in, has started to trend down. Our concern here is that we kind of generally want to think of that if your expectations of how your household finances are going to be 6 months or so out in the future, that's going to impact on what you're spending, particularly for big ticket items, cars, refrigerators, housing, things like that. Having said that, the research that's been done by economists, financial experts, it's really not that kind of a direct correlation, but it does give us a sense of overall, should we be more cautious? And the answer is, of course, yes. Prices, well, apparently we have hit peak inflation. So retail prices, consumer prices down about 6.5% month over year. Still being some of that pullback is because of energy. I'll show you some stuff on the next slide to get into that a little bit, but moving in the right direction. But one of the things that I would tell you is we've got a long way to go before we're back to that 2 to 2.5% range. So yeah, we're moving in the right direction, but there is nothing in this data yet that tells me that the Fed is actually absolutely going to stop raising interest rates. They may slow down their pace, but there is certainly a long way yet to go to hit those target levels. And I'll talk more about my outlook for that in a little bit. Producer prices. So this is one where the number has actually come down faster in the last reporting period for the November, December time period than what CPI. And that's the first time that's happened since we've had this spike up in inflation. And this is good. I'm more interested in the producer prices, because if producer prices don't come down, then consumer prices will have to stay up. Otherwise, we're talking about companies losing revenue and going out of business, because you just got, if you can't cover your cost, you're not going to stay in business. But look at the little number that I have over there. Of that drop that we saw, gasoline prices year over year have dropped 13.5%. And of course, that affects both consumers and producers. And it gets reflected somewhat. The price has not changed quite that much for diesel, but still transportation costs are down. Services prices, though, for producers has actually risen a little bit. But compared to that peak that we had in March of 2022 of 11.7%, this looks a lot better. But again, still a long way to go. 6.2% is a long way from being stable yet. A couple of things getting back to hammering on this issue, and I don't mean to overdo it, but hammering on this issue about the job rates is a couple of stats that I've started to look at a little more carefully as we go. This comes from Bureau of Labor Statistics and is an indicator of job opening rates, and then looks at the difference of hires and separations. And the two things is, one is job opening rates are still pretty high. There are still, I think the number is, if you look at all the people who are unemployed looking for work, forget about matching skills or anything, there are still over 800,000 more job openings than there are people looking for work in this country. And if you get to that in the long run, if you look at that next slide over to the right, that red line is separations, the red dotted line, and the blue line is hires. Separations are still running below, though it's a little closer than it has been in recent periods, but it's still running below the hires, which means that net we're adding jobs in the economy. If you're going to have relief on upward pressures of wages, I think we're going to have to see job losses. I just don't see where you get around that. The supply and demand factors still work. Interest rates overall, I mean, this story. Fed funds rates are running now a little above 4%. Treasuries, of course, now we had a really interesting early week this week in terms of bond issues and where some of the interest rates come down, because bond prices have really gone haywire and gone very positive so far this year, though it's selective. So junk debt, low-end corporate debt is not doing as well, but still interest rates much higher. And then we have this all-important impact that we've seen on mortgage rates. It's not like that, talking about the 6.5% or so that we were seeing earlier this month. Historically, that may not be that bad. I mean, I'm always reminded that my first mortgage in 1987 was 10.5%. I wasn't quite in the housing market during the days of the 16, 17% mortgages of the early 80s, but I think what we've had is that this increase has happened so rapidly. That spike over there on the right side of that chart is so dramatic that we've shocked the system, and we've shocked folks doing it. And it's having several different impacts that we'll talk about later in our local housing markets. But it's just an incredible shock. I think that mortgage rates are going to probably stay pretty elevated throughout this period of time. I mean, I don't see any reason for them to go back. If you were waiting to get a 3% 30-year fixed mortgage, you've waited too long. Full stop. But here's the other thing with the feds. It's what's sitting on their balance sheet. So they've started unwinding their positions a little bit. So they've dropped, a couple of $100 million a couple of $100 billion in the balance sheet. But look at that rise since the start of the pandemic, and then look at what we did after the Great Recession. We just kept doing quantitative easing. I mean, QE1, QE2, hell, it might have been QE12. I don't know. The point is that we went from the Fed holding less than $1 trillion to the Fed holding about $4.5 trillion in the period between 2003, 2005. And then you kind of fast forward, and during the pandemic, that balance sheet went from about $4 trillion to over $8 trillion. That's a lot of intervention in the market, which had a lot to do with the cheap market rates. Uh-oh. Did we lose our signal?
We can still hear you.
Okay. Thank you.
We can't see you, but we can hear you.
All right. I'm not sure what happened with that, but that's okay. We'll try that. And there I am. I'm back. So the mystery gremlin of Zoom decided to shut me off, and I probably look better. What was that? I have a face made for muting the video. Okay, thank you for that. But you see, the point is that it's going to take a long time for the Fed to rationally pull down that level of reserves. And that means that you're going to have elevated interest rates, because they're going to be flooding the market with supply for a number of years now. So I think the era of really cheap interest rates are done. And of course, all of this has impacted housing sales. And we'll talk about some examples here locally in a little bit, but look at that 37% drop in existing home sales from November of last year to November of this year. New home sales also down a lot. And there's two sides of that. First of all, it's an affordability issue. I'll give you a little preview. One of our regional housing economists, Lisa Sturdivant, back at the end of summer was making a comparison, saying, August, if you were looking for a house in Arlington, the mortgage you could expect to pay, given the the rise in housing prices and the change in mortgage rates, would have meant that the difference in that same house between August of 21 and August of 22 would be 44% higher monthly mortgage. We'll think about what that's doing to affordability in our region, of course. And of course, the other thing is, like the house that I'm in now, I'm sitting on a 2.75% 30-year mortgage. I kind of like my house. I love my mortgage. I'm not leaving here for anything. To take a 6%, 6.5%, 7% mortgage. No, not happening. And so our inventories are getting tighter and tighter, and we'll see more of that in a little bit. This is one I just wanted to toss in just as kind of a help explain some of the stuff that we're seeing in the market now. So e-commerce retail sales, obviously just spiked up. The one thing that the downturn in the pandemic and that shutdown taught us is that we as a nation are incredibly adaptable. Our retailers are absolutely brilliant at figuring out new ways of separating us from our money. and they figured out a way to adapt their marketing chains and their supply chains. Now we're having increasing, you see that steady rise in e-commerce rates. And this just goes back to 2015, but rising anyhow. But we had this rapid increase. Now, what we're seeing now is we've fallen back and we're kind of restabilizing. Now, depending on where you do it, if you thought about trying to draw some kind of a recession line along that 2015 to 2019 period, we're still above that line. And I would suggest, by probably about 1.5%, something like that. I think that we're going to probably hang on to this, and then we'll see, some fluctuations, but I don't know that you're going to see much more fall in that. But what was happening, Amazon, Macy's, all these others that were converting to that and adding warehouse space and doing, in their e-commerce infrastructures, they actually started hiring in 2020, late 20, and through that, the early part of 2021. They were hiring like that slope line that you see there from late 2019 into 2020, that spike there, that was the new trend line. And it resulted in overhiring. I saw some stuff where Amazon, something like 20% of all of their employees worldwide have been added in the last 2 years. So, it's just they've admitted we overexpanded, and that's what you're seeing now. Microsoft, Amazon, all of these companies that are now announcing layoffs. It's just a matter that they overramped. They just took on too much too soon. Now, growth will eventually catch up with that, because this will continue to trend upwards. So our stories for the U.S. economy, largely speaking, I expect inflation to be elevated. I think we'll see it continue to come down, but by the end of the year, I'm hopeful that we'll be around that 4.5% or so on average. There are some factors there that we just don't know. I mean, what's going to happen in Ukraine, other kind of things, oil shocks, all that kind of stuff that will impact that. I expect us to see it come down, but if you look at that, I'm actually expecting inflation rates to be above Fed target levels through 2025. So that means that this era of tightening and raising interest rates and all of that is going to extend. The only way for them to have that not happen is if they achieve some kind of a soft landing, immaculate disinflation that somehow changes the pricing structure of labor without resulting in a bunch of layoffs. I'm not quite sure if that's even theoretically possible, but I'm still expecting these kind of elevated inflation rates. Now, mind you, if it gets down to 3%, that's not, certainly you want the target lower. I understand the reasons for that, but I'm not going to freak out about a 3% on inflation rate. But again, this is going to be it's going to take some time. Interest rate hikes, I'm not going to tell you, I can't even begin to say, are they 50, 25 basis points? I don't think we're going to see any 75 basis points now, unless the inflation numbers go wonker in the wrong direction again. The pause in timing, I think we'll certainly see that. We're even seeing some pause now. Let some of the existing things turn. The analogy I believe that I used last year in the talk still applies. They're steering the U.S. economy is like a super tanker. You turn the rudder, and some number of minutes later, you actually start to swing. The thing that I learned at the Maritime Academy is that two super tankers on a collision course that are 5 miles apart will collide. It just takes them so long to turn. And that's the thing. Now, the problem is that when they start swinging in the turn, you have momentum. And so can they time it? Do they have the swing right to where we don't swing into some kind of a really bad recession? But I think that we will see still the potential for 3 hikes, because mostly while some of the other pricing, we're seeing things like transportation pricing is certainly coming down. It's not completely disinflationary, but we're seeing some of those pressures come down. The supply chain problems of COVID are unwinding. to a large extent. And indeed, the big JB Hunt, the largest trucking firm, is kind of recently commented that what they're seeing is some fluctuations now that suggest more normal seasonal patterns, because seasonality went out the window with the pandemic. So we're seeing some things moving in the right direction on that. As I say, supply chains unwinding. The China COVID thing, we're kind of hopeful that they've done away with this, and this will help free up some supply chains, make some goods, bring some goods back on the market. However, I saw a deal today where President Xi has now said that, they're getting more concerned about the spread, because the thing about their COVID approach, the COVID zero approach, is it was not building up any kind of real immunity, natural immunities or anything that you'd see develop. And so therefore you now have rural areas of China starting to really get hammered. So whether or not they go back to a COVID zero thing, that's one of our unknowns, and certainly will impact the supply chains and could start causing hassles again. Yes, we are trying through industrial policy to mitigate that by, creating new chip industries here, and we're going to subsidize the hell out of them. I'm not sure how that works in the long run, about whether or not without the government subsidy they can still stay competitive in the long run, but certainly you throw a few $1 billion at companies and they'll build the factories and build them here, but those factories are not going to come online until probably at least late 2024 and maybe beyond. The stock market, well, Bitcoin, gosh, what can you say? The odds were not in those folks' favor. Is there a role for Bitcoin? Yes, I think that there is a role for digital currencies and things like that. But understand, this is not currency replacement. This is largely pure speculation. And unfortunately, we have some ordinary folks who have gotten hammered. If Matt Damon loses $10 or $20 million on Bitcoins, well, you got paid well for trying to boost it in their advertising. But if we have regular investors who have put substantial money trying to ride that wave, I'm afraid, that they're looking at, let's say, their retirement horizon just got stretched out a long ways. Basically, with the ups and downs that we're seeing, I think that the stock market is going to be incredibly volatile throughout the year, but at the end of the year will be just slight growth on average. I'm basically sideways movements. 2024 will look a little better, but whether or not tech is still driving that or not, it's interesting. I can't help but think that there are some, not in a real sense of Schadenfreude, but there are some people who are not in the tech sector, CEOs in the not sectors, that are kind of not really laughing at somebody's trouble, but kind of saying, well, guys in tech sector, welcome to the days when revenue matters and bottom line matters, as opposed to just whether or not, you can get more people engaged, that we want to see actually some bottom line strength in your numbers. So earnings back in vogue, but that being net earnings back in vogue, not just revenues. Conflicts, well, Ukraine's going to continue to drag out. You got these different elements, but if we start supplying tanks, maybe that helps shift the balance. But Putin cannot afford to give up. So I don't know but I just presume that that's going to be on. Taiwan, I think you're going to have lots of saber rattling both on back. I am not particularly afraid of China invading Taiwan, but certainly it could be disruptive, the fear of such, and we'll see how the Taiwanese respond to that. But there's one thing: the Ukrainians have kind of set a stake in the ground that stand up to the bully next door if you need to. And my friends who are Taiwanese tell me that they think that would be more of the case for them. It's not like, that China would be threatened to come across the state and they would just capitulate their nation. I just don't think they would have it. Federal spending. So I certainly think that we're going to see a slowdown in the spending about COVID stuff. Keeping in mind, the last time I looked, and this has been a few months ago, out of the $4 trillion or so that was authorized for spending on COVID relief, about 500 billion of that has not been allocated, spent, or whatever, or has not been put into the marketplace or awarded to anybody. And given what's going on with the after the November elections, I kind of doubt if that will be. And there's pretty good arguments now to where we don't need that. And in fact, it probably there's no doubt that some of our inflation that we saw was helped at least by the level of federal spending that we were doing. Having said that, the infrastructure bills will start to kick in the next, later this year and next year with some planning stuff as that money gets distributed, and that will be flowing through the economy for a few years now. And we can talk more about that later, about the particulars of that. Debt ceiling and funding dramas. It seems that we're destined for that kind of stuff. And certainly I am one of that. If we somehow breach and if we have a downturn, it certainly is going to impact our region. I just, this notion that we have legislators standing up and saying, oh, well, it really isn't going to matter if we default on debt. It's like, that's kind of like, okay, you tell that to your community meeting where you're talking to your greatest followers, but don't speak it to us like it's truth. So the bottom line for the U.S. economy, job growth will turn negative, I think, sometime during the second to third quarter of this year. If you had asked me 4 or 5 months ago, I would have said the first quarter of this year, but obviously December job numbers say that we still have strength. We get more net numbers that are suggesting if these layoffs, as they start kicking in, and keeping in mind the announced layoff, it may take months for that to actually show up from these tech firms, but I would expect us to see flatline to somewhat negative growth. The Fed will slow their pace of rate rises, but again, as we talked about, between needing to continue to fight their inflation battle and trying to unwind their assets, interest rates are going to stay high. So that's going to make it tougher on businesses. And they're trying to use interest rates to reduce inflation, but raising an interest rate is inflationary itself. So you have to do it enough that it kills underlying demand. Well, we're starting to see, the softening. Retail sales, November, December, month-on-month drops in both of those. And some of that is with the banks now charging people 24, 25% on their credit cards. I do think that we could, I'm still just saying that the safe way to assume for next year is that the US will enter into a relatively shallow recession sometime mid-year, give or take a few months. I'm not expecting anything deep or dramatic, but I do think that we will see continuing slowdown into negative, because I do not believe that, as smart as the Federal Reserve is and Chairman Powell is, that they're going to be able to craft this immaculate disinflation that doesn't actually harm the underlying economy. I do see growth returning early in 24, but it being very sporadic. And so we're going to I think it's one where we're going to drop a little bit, and then we're going to kind of bounce. So think about if you were fishing, bottom fishing, where you drop the lure down the bottom and you kind of bounce it along the bottom. That's going to be the direction of the economy, I think, well into 2024, with then perhaps some growth returning in the latter part of next year. All right, so moving on to the Washington economy. And again, I'm hoping you stay with me. I'm hoping that nobody is reaching for the Xanax or any other kind of stimulant packages go in. Here's one of the cool things that we have. So this chart is something that I have not used in my previous presentations with you. It comes from the Fuller Institute. It was indices that Dr. Fuller developed about 25 years ago and has been using it to track the economy. It is a regional economic index, very much like the leading index. There's both a leading index and a coincident index. So the coincident index kind of tells us what are we doing now, and the leading index is a measure of what we think is going to happen in the next few months. And you can see that, it was the leading index was trailing downward before the Great Recession. And then, of course, the COVID thing was such an abrupt spike. Of course, there wasn't much to that. The thing that I want to point out to you, though, is look at what the pattern looks like after that recession, the short recession that we had from the pandemic. Look how volatile particularly the leading index has become. And what that's telling us is while the numbers are showing that, growth potential, it's a lot less certain. And quite frankly, I will tell you that we are in the process of evaluating the underlying structure of this index, because it could be that changes that have occurred in our industrial structure related to the pandemic effects, remote work, online retail, things like that, are changing enough that we need to tweak some of the weighting that we have in these measures that are composite measures of several different underlying economic indicators. So you can see what we're going on. So while we think that the news looks, it's not trending down in any sense of the word, but I'm a little more skeptical about, its predictability until we get a chance to look at it. Having said that, start looking for this, and we'll find out in the coming months if it is hold true like it has held true for the previous couple of decades. Job change. We continue to work toward recovery, but as you look at the level of the line there by the green line that you see on there, we are still below total employment. It's getting closer to recovery, but unlike the nation, we have not recovered to pre-pandemic levels of employment. And we'll talk about some of the specifics of that in a little bit. If you would think about it, in a usual year prior to the pandemic, 64,000 job growth, and November is the most recent data we have available. So comparing November 21 to 22, 64,000 would be a very good year. A good year for us in this region is about 50,000 job growth, as you can see by that long run trend on that, going back in history. But the pace of the job growth has certainly slowed. And I get anecdotal evidence from talking with business leaders that they continue to struggle to find people. We still have a whole lot of open positions, both in tech and in our hospitality sector. One of my little cafes near where I live basically shut down because the sign on the windows said basically we can't find the workers we need, and we just can't do business now. And I've was on a call yesterday with the advisory group for the revenue forecasters for the District of Columbia, and the Restaurant Association is saying that very much thing is that they're still very constrained. Folks who left that work or couldn't go to work during the pandemic have not returned, not completely, obviously. One of the other things that I want to note to you is, given the shifts that we've had in, with control of the House shifting to the Republicans, go back and look in 2013, 2014, the last recession we had in this region and where we had absolute job loss occurred because of the Budget Control Act and sequestration. Now, there's no way that's going to happen with a democratically controlled Senate this time, but we are at risk. If there is an impasse and the House fails to pass something, then we could see some disruptions in federal employment. Now, typically what they do is they make the federal worker whole, once the shutdown occurs, but it's going to be disruptive for our economy if we see that happen. So let's look at by sector. Professional and business services has grown. We are above, again, the notation in the red box tells us where we are compared to February of 2020, so before the pandemic. For us, education and private education and health services is still down. Some of that is labor constraints. It's really interesting the extent that we burned out a lot of healthcare workers during the pandemic, of course, and I fully understand that. And it's very hard to attract. We got a lot of nursing positions that are still open. I heard in a briefing to the Virginia governor, I heard somebody talking about in the healthcare sector elsewhere in this state that it cost them $300,000 to onboard a nurse. $150,000 bonus to the nurse and $150,000 fee to the employment agency that's bringing the nurse to them, which of course makes me think that I am in the wrong damn business. I need to be in the recruiting business for healthcare workers, except that they're probably having the same problem and nobody to find. Federal government is down. That's interesting. It's not, it's not that extent on a national basis, but we have maybe some displacement going on. And certainly what we have, no official freezes are in place, but we seem that some of the retirements of employees in some agencies are not being backfilled at this point. And some of that is not being backfilled because of, again, a very tight labor market. We'll talk more about that in a little bit. State and local government is up just slightly here. Leisure and hospitality is still down about 17,000 workers. And, and again, it's not just demand. In DC, they're still having troubles about the lunch counters and stuff like that because of lack of going back to the office, but it's still overall a very tight labor supply for leisure and hospitality. Retail trade's actually up a little bit. It'd be interesting to see how that goes because there's all sorts of notice of the conversions going on between, more say residential conversions at shopping centers or other type of commercial activities. I saw a very interesting presentation from a group out of Portland that was talking about that they're using old strip centers and redeveloping them for middle housing and providing some incentives in sense of not so much direct payments, but incentivizing developers to put middle scale housing up on these old strip centers while still allowing some retail like on the first floor, so doing mixed use development. And they've got a project that's starting this spring to see how their early programs that they started a couple of years ago are actually working out. So I'll be interested to follow that as a model for us. The financial sector is an interesting one. So the numbers that you see now, we're still down about 11,000. So we dropped out. Our most recent drop, though, can really be associated mostly with what's going on with residential real estate. So the financing side of that, if you will, the mortgage brokers, of course, have started to release people because we've got 25% drop in housing activity, if you will. The other piece of this that I think is less obvious is we're still seeing some consolidation in our regional banking structure. And so some of that has been some efficiency gains from mergers in our regional banks. And the other is that whether it's regional banks or the big national banks, they are continuing to close local branches. There just simply is not going to be a Wells Fargo branch on every corner kind of thing going forward as they try to compete with SoFi and other these banks that are doing all, basically all virtual type of stuff. So that shift it helps explain the financial sector a little bit. Information is actually up a little bit, web hosting and all that, and that's continued. That's things like Amazon Web Services. I will make a little pitch here. Northern Virginia has one of the highest concentrations of data centers in the nation. The whole thing about 70% or whatever of the internet traffic of the world passing through Northern Virginia, I think that's a myth. I don't that's not a play. And indeed, on a state level basis, Virginia is not bigger than California or Texas. And increasingly, Ohio is a big player in this. So while we are a very highly concentrated region, there are other regions that are competing aggressively for it. Now, one of the things I think is real interesting is that some would tell you that Phoenix is increasing, but given the water demands of that industry for cooling, I can't see any reason why they would pick Phoenix. Arizona's running out of water, full stop. We've seen some articles in the Post about that recently. But here's one of the key things that I think is worth you guys looking at if you're interested in that sector. One of the reasons Northern Virginia established its dominance early on as a regional center was because Virginia was an early participant in creating an incentive package where they waive sales taxes on capital equipment in data centers. And remember, those data centers refresh their equipment every 3 to 5 years. So it's an ongoing thing. Well, there's a real argument now that that bill that created that included a sunset provision that says in 2035 that goes away. That doesn't mean that the legislature couldn't decide then to redo it, but you now have data center developers and data center operators are getting very concerned about whether or not that's going to stay in place, because in the meantime, these other states are offering other type of incentives. It's not exactly all that same kind of stuff, but we are in competition. But there is a real push right now among some in the state legislature to undo that, because by value, the incentives that are offered to the data center are the biggest incentives that we offer any industry in the state of Virginia. So it's a really interesting thing. And of course, now you have this whole thing about the Prince William County planning and the redevelopment and whether or not you should have data centers next to battlefields and things like that. I'm thinking I can see the notion of the argument about not having data centers next to residential areas, but I'm not sure that I understand, the reverence you hold for these Civil War sites, but I'm not sure that I see that as it should be a buffer zone for an industrial activity, particularly one that contributes greatly to our tax base. Loudoun County estimates that for every dollar that they spend providing services to the data center industry, they get $13 in revenue. So your question is, if you start undoing that data center industry here, where is Loudoun, Fairfax, and Prince William going to get that additional revenue that's paying for a lot of city services? So it's a really interesting question. The other thing that's interesting is I interviewed, as part of some recent research, a group that does cooling systems for data centers, and they're actually looking at technologies, experimenting with technologies to use that heated water after it comes to the data center. If you're close enough to a residential, you can pipe that heated water to the residences to contribute to their home heating in the wintertime. It's going to be real interesting to see how that does, and whether or not somebody would say, well, I don't want to be next door to a data center, but if I can heat my home for close to free for the winter, maybe it's not such a bad trade-off. So we'll see how that goes. Other sectors here you see are to be about expected, but largely speaking, we are seeing some still positive trends, but there are emerging signs of weakness that we need to talk about. Again, federal government stuff down. The interesting thing is going to be is, what does the federal government do long-term? Not so much about hybrid work. Hybrid work doesn't change where people are, but if they're going to allow remote work, are we going to see fewer federal workers? Their job may be listed here, but they're not spending their earnings here. They're spending their earnings elsewhere. And I think that's a real key challenge. And of course, that's the overall. You remember last year, I was telling you a number that if you looked at high wage jobs prior to the pandemic, about 4% of jobs that paid more than $100,000 a year were located truly remote. Not the person was not located in the city or the region where their job is. That number had gone up to 18% by the end of 2021. I have not seen that survey updated now. I expect that moving forward, it will be higher than 4%, but we're going to certainly see some pullback on that. And we're seeing we can talk about that in a little bit, but federal government employment is dropping. And I think so far we have to assume that some of that has just been a matter of not replacing retirees, though there is no actual official moratoriums. You look at the federal spending numbers are continuing to go up. I expect that 2022 will look a little bit less than 2021. Not as big a drop as you're seeing there, because there's still data for 2022 spending coming in. So there's still some leeway there, but you can see that number has gone up again, and you see the effect there. You can see a few years ago the effect of the budget sequestration. Professional and business services. So we separate out professional, science, technical versus administrative support. So think like personnel agencies, security guards, services to buildings. That's represented in the orange. That's who took the real hit during the pandemic. And interestingly enough, I'm really watching it now. Notice that in the last couple of months, those numbers and the administrative side have started to go negative again on a month-over-year basis. So we're really carefully monitoring this, because this suggests to us that, is it a reflection of weakness in commercial real estate? Well, we got a lot of numbers that say we are, that, simply the hybrid work really starting to kick in, lots of vacancies. Those vacancies are increasing. The sublease rate has really gone up dramatically in the last couple of years. So yes, and we'll talk more about that in just a moment. And these are a couple of the ones that really I'm tracking to see. First of all, computers systems design, we had that downturn during the budget sequestration, but going up. But notice that we flattened out. This is an area that we're supposed to be very competitive in. So that flattening out is worth us really kind of monitoring closely, and we'll see. And when I get down to this level, I'll have to look here in a few months. I'll get the 2022 data to see, but we're concerned about this as a trend. And that same level where we got a little more quarterly data here on cybersecurity. This has been one of our key. We have more cybersecurity workers by far than any other region in the country. And yet we're starting to see a slip. Now, pay attention to the scale I have here. It kind of makes it a little overly dramatic on the scale, but nonetheless, we're talking about a sector in the last 10 years, instead of growing in strength, we've actually net lost about 3,500 jobs. So are we losing that? And I think some of that is because that for so long now we've had open positions. The numbers were in just the tech sector, 160,000 job openings at the beginning of last summer, and stuff like that. And it's not that high now, but it's still very high. And have we reached the point where companies have just said, we're going to have to look elsewhere? We're not going to grow here. We're going to look elsewhere. And that's a real concern for us. District of Columbia, growing. As you can see here, and certainly the change is positive. Having said that, though, they are still, again, you note the difference here on the green line, they are still substantially below, about 20,000 below where they were pre-pandemic. And I think that growth is going to slow down a good bit, as you've been seeing in the trend for the last several months. In suburban Maryland, a little bit of a bounce back, began fall in trade. And suburban Maryland really they just haven't performed as well. And I think a lot of it is perceived policies in Montgomery County. Quite frankly, it's not perceived as being business friendly. Prince George's is perceived as more business friendly, but they still have a hard time gathering interest other than relocation of federal entities. There will be a shift coming up. The BEA, the Bureau of Economic Analysis, the Bureau of Labor Statistics are leaving the district and are going to move out to the Census Bureau's building that's in Prince George's County, which is a good use of space, but is going to shift employment and open up more office vacancy in the district. And then Northern Virginia, numbers are more strong, but certainly slower than they had been. But as you can see, in Northern Virginia, we have actually recovered to our pre-pandemic levels. So the place to be in the last couple of years, apparently by the job numbers, has been Northern Virginia versus our other two major sub-regions. And the unemployment rates, Northern Virginia 2.6%. So that's down kind of not quite as low as pre-pandemic, but that also tells you that you folks who out there, there still looks to me to be more of a problem about you can't find the workers you need, as opposed to you having too many workers. And this is riding on productivity, and it actually is slowing our growth down. And indeed, it's one of the things that helps explain this, but I am very much becoming concerned about some numbers that I'm going to present to you over the next few slides about our long run competitive position. We, at this point, and this has been true for several months now, if we look month over month, and in fact, going back into last spring, that if you look at the other major metropolitan areas of this country, our relative position is dead ass last. We are just not growing as fast. And compare our 1.9% to Dallas, Houston, Atlanta, and even some high cost areas like Boston and San Francisco are doing better than we are. So this is very, very much an area of concern. And I think it's still Some of it may be some structural issues, but I think a lot of it is labor availability. We simply can't grow our economy if we have very low unemployment rates, and they add on to that then a skills mismatch. It's not just whether or not they're people looking for jobs. Are there people who are looking for jobs who, and it's not even the right technical skills, as I've talked to you before, it's the right workplace skills. Do they know how to be a good employee for you coming in? Do they know how to deal with corporate communications? Do they know how to use tools like Slack or Salesforce? And quite frankly, do they know about showing up on time and dressing appropriately? All of these are things that are of a concern in the workforce. So let's look at this on a little bit longer term average, comparing GDP growth by decade with the nation. And you see that, okay, a little bit better in the 70s. We killed it in the 1980s. 1990s basically flat. We did better in the 2000s, and that was largely because during the Great Recession, the underpinning of federal government kept us going when the rest of the nation fell down dramatically, so we outperformed. But in the going through 2019, we have been consistently underperforming in terms of GDP growth. And in this case, gross regional product, GRP, which is the equivalent of gross domestic product. And I haven't done the numbers. We do have some numbers out for GRP for 2000, and I think there were some preliminary numbers out for 2021. But all of that's impacted so much by the pandemic that doesn't tell me anything about trends. But I'm very concerned about what's happening here. And indeed, if we kind of do this on a by year basis, you can kind of see what's going on. And where you see is that we certainly are seeing a little uptick toward the end in rates per job. But this is kind of right in here at the end where you see that kind of acceleration on gross domestic product per job. Some of that is not because of adding so much value to our high-end jobs, but that where our real weakness has been here, more so than even the rest of the US, has been in the lower level jobs. So if the restaurant jobs and the hotel jobs are going down, then that drives our average artificially higher a little bit, because that means that, proportionately we have more of the higher end, more value added jobs. My point of this is that the gap is, it's staying a little bit stable, but I'm concerned that it's some artifact in here and that we're not truly growing quite the way we should. If I look at our job performance numbers and I just create a ratio of DC versus US in terms of percentage job chain, then, again, kind of killed it in the 90s. 2000s, we were a little bit saying, you can see the effects. You can see that little hump there in 2008 to 2011. And then, since the nation came out of the Great Recession and started truly getting back to pre-Great Recession levels of economic activity, we've been on pretty much a little bit of a downward trend. Again, it's not a big difference, but it's a trend line that's worrisome. And we're going to start talking about why here in a minute. And if I create that on a performance index, again, I'm just illustrating here that this is a piece of data. Oh, and by the way, I'm sorry, that blue line across there should be down a couple of notches. I put that in the wrong place. The 0 line is the one that matters. I thought I fixed that. So again, we'll call it a Zoom gremlin, but you can see where, particularly in the last several months, we have had substantial. I don't have an explanation for that bottom spike yet. I don't know if that was a data aberration, but the point is that the trend line is certainly down. And here we get to the challenges. This data, we've reported on this in previous presentations, looks at what's happening with population growth separated out into 3 components: natural increase, which basically births minus deaths, net international migration. So do we have more people from outside the country coming in versus those that are leaving. And then domestic migration, which is people that were already in the US, whether or not they're citizens, where they previously were in the US, coming here versus leaving here to go to other places in the US. And as you can see here, that number has been negative. Now, keep in mind that if you go back far enough, you'll see that it's not completely unusual for us to have some domestic outmigration, particularly in years where the US economy overall is doing very well. The federal government is a buffer on both sides. It's a buffer on the downside, but it also is a little bit of a soft ceiling on the upside. But you can see where we've had some fairly dramatic losses. And of course, one of the things that's also has happened is the rate of net international migration has also been increasing recently, decreasing recently. Some was policies put in by the Trump administration, and some of it was COVID. But that one where we really saw in the last period, these data are measured from July of one year to June the next year. So our most recent data ended in June of 2021. Here in about late March, April, I believe we'll get the next year iteration of this data, and we'll see. But we actually had year-over-year population loss. Unfortunately, this is not just people who fled the pandemic and are coming back, and it's not just retirees. What we are seeing anecdotally, and we've talked about this before in some of our sessions, that we have prime age millennial workers who are leaving this region because of housing affordability, affordability of services, transportation frustrations, the whole bit. And that seems to be really challenging us and holding us back on growth. We're going to talk more about that in a minute. So let's talk about housing inventories. Look at that. I mean, think about this, what's been going on with our inventories. This is based on the MLS data, multiple listing service data, inventories measured at month end. So just a count of at the end of the month, how many houses were on the market or were in pending listings. So the sale they may have a contract offer, but they weren't closed yet. And just look at that, since 2015, we've been on this long run decline. In fact, when I'm doing work for the Northern Virginia Association of Realtors, it's kind of like, how low can it go? You keep thinking, no, inventories can't get any lower than that. But just the month of November, which is not usually a super strong month for sale, but about 2,400 less homes on the market, if you will. So that's a big drop in month over year. And some of this is because those of us who have very nice mortgage rates are not willing to trade houses to see our mortgage rate double, or the fact of, we don't have availability of housing for families who are looking to afford housing. An interesting piece is we always think about millennials liking, the urban environments and all that. The Housing Research Center at Virginia Tech, a few years back, I worked with them on quite a few projects. They had done a survey of millennials, and this is about 5 years ago now. But millennials, when they start forming families, their desire for single family detached homes is virtually identical to previous generations. So, I've always liked a kid that, hey, it's really cool being in a flat above the bar until you got a 2-year-old that you're towing around with them, right? With you. So it's a different dynamic, and simply we don't have product at a price they can afford or even have it available, as you saw the craziness in the real estate markets over the last year. And of course, this is starting to have a real dramatic effect on home sales, in addition to the notion of just the mortgage rates and everything else. It's a combination of the two. So it's both supply and demand affecting home sales. And let me put something in perspective here. Let's think about this. So these are all MLS data. So this is stuff that would be running through realtors, right? So this is not your for sale by owner kind of stuff. And it's not homes that are being sold by builders, new homes being sold. This is stuff that's out there. And you look at that difference, that 2,600, almost 2,700 homes differences. If I take kind of an average commission rate and I apply it, that would tell me that the real estate sector, the real estate transaction sector, just the brokers, right? The brokers and the realtors have suffered about a $66 million loss of revenue in November of 2022 versus November of 2021. Now, you start adding that up over a few months and you're talking about a lot of lost revenue. And that doesn't account for like the mortgage transactions and the title companies and everything else. That's just simply what you would associate with just the commissions on a sale. We have a lot of building permits that are being issued. We did an event in November where CRA and SF and the Fuller Institute were joining up, and actually had Dr. Fuller down from where he lives in Maine now to speak at that. And Mark Elrich was, who is the county exec for Montgomery County, was actually in the audience and brought up the notion that, well, I've approved 18,000 residential permits and there's no construction activity going on. And of course, part of it is, yes, and it's all the other regulations and taxes and everything else, and the cost of materials, the availability of materials. But in fact, the point is that even though we show some improvements over the last year or so in the number of building permits, that does not mean that we are seeing new housing units appear on the ground. And it's a real challenge. And one of the projects that I'm working on at the moment is for the Virginia Department of Professional and Occupational Regulation. Now, many of you may not have known that there was such an organization, but what they do in part is regulate community interest, common interest communities. So homeowners associations, condo associations. After that building collapsed in Florida in 2021, our legislature last year said we probably need to look at something about reserve standards in condominiums. Is there a problem about maintenance not happening that is going to threaten it's going to threaten safety and even lives in our condo communities, especially. So they asked for a study to be done by this agency. The agency contracted with CRA and some other universities to help them work through the data of it. And it's a really interesting thing is to see how underfunded many of the reserves at our condos are. And you think about that is the lower cost entry point for folks who are young families, people who are working households, maybe not at the high end, but workforce housing. So people that are earning $70,000, $80,000 a year in a household that may be earning $100,000 or something like that. So this is not poor folks, but that's where our affordability is just so out of whack. But unfortunately, we're finding where many of these properties, they may be paying $500, $600 a month now for their dues, but maybe those dues or special assessments need to be much, much higher so that those older buildings are being, you can repair them in the fashion they need to be repaired. It's a really interesting challenge moving forward. And of course, the sales price, we're seeing some slowing of the sale price just because of demand slow, because, it's a reaction to the net effective price. Of course, it's much higher because of mortgage rates, right? But you're certainly seeing some slowdown. I do not see this market collapsing, by the way. There's still enough underpinning demand that I do not see prices really on a large scale dropping down. There will be some. And what we've seen in the marketplace is that where we had areas of this region where the ratio of sale price to original list price had gotten to be like 105%, 110 on average. And so that meant that, everything was getting bid up. We're now seeing that more like 92% to 95, 97%, which is more of a normal market, kind of thing. And so, yeah, we're getting some, and 92 is a low end of that. Really, most of it's in the 97, 98% on average. And that's more of a normal market. That's where you go in and you negotiate. And we're also seeing some sanity come back of, you actually have some things about doing an inspection on the home and things like that. So it's a little bit of normality returning. So what are our stories here for 2023 and beyond for our region? Talent. Our big issue is workforce housing. Public transportation is a real problem. I'm sorry, but Metro has got to get its stuff together. I am so tired of this stuff of reading papers where, they're doing this back and forth and between the safety commission and them. And it just means that we don't have the right kind of service. And Metro has got to figure out how to do all this because they're facing a fiscal cliff like you wouldn't believe. We actually did work for them of looking at that, assuming hybrid is here to stay in some form, at least for the next few years, what does it mean? And their revenues, think about this. If you have somebody who works from home 2 days a week, that's 40% of their commute. So if Metro is relying on that fare box revenue and you have 80% of their riders, particularly on the rail, are in occupations that have a likelihood of being remote or at least hybrid work, that's a lot of revenue that's not being made up. And we have some hard choices because I don't see any path forward except for the contributions of the states and the localities to subsidize Metro comes in. And the fact of the matter is, if you say, well, we're not going to do that, then expect traffic to be a nightmare in this region. That's full stop. Resources for young families, and that includes availability of childcare and other things. I worked on a program in the late 90s down in Texas about, something about companies looking to do to provide childcare services. Of course, corporate attorneys got involved and it scared everybody to death about liability. I think that there's got to be some rational way of public-private partnerships to help families be able to get back into the workforce. And I think that there's a real payback to that. I don't have exact numbers to share with you. The vitriol in policy making, I think that's actually the level of the dysfunction in federal government, I think is actually starting to have an impact on the number of young people who want to come to work on the Hill. And that has traditionally been one of our key sources of long-term labor. I mean, they kill themselves working on the Hill for a few years, and then many of them, some of them go home. Many of them stay in the region and wind up working in the private sector, local government, nonprofit, whatever, advocacy agencies, whatever it is. And I think that we have a problem now that working on the Hill is not as attractive as it used to be. And then, of course, the other is incumbent workers. We haven't even talked about artificial intelligence and some of that kind of stuff and the impact that could have on our workforce, but we're getting more aware of it. But how do we retrain incumbent workers? Think of the displacement that we had in manufacturing workers over the last 4 years. Well, apply that to the white collar labor force, particularly the white collar labor force that may not be highly technical in their occupations. We're still working on the work from home, remote work. OPM, the Office of Personnel Management, has not given us any guidance on the federal stuff. So everybody's just kind of waiting. And in the meantime, massive shakeouts are happening in the office markets. Vacancy rates are at record levels and likely to get worse. We have a huge amount of Class B and C properties that will be coming on the markets in the next 4 years. And the building manager's got no idea. And we will do some conversions, but conversions to residential mixed use is a spot thing. And we'll have some examples to see whether or not it really works, but you can't do that. So again, we have some adaptations and our ability to adapt to the needs of the entrepreneurial and ecosystem. I call it innovation indigestion because, we saw a real fall off last year in things like venture capital money, and with higher interest rates and tighter and people losing so much money on crypto and all that, I think that's going to wind up hurting our entrepreneurial sector, particularly the innovation side of that at the low end, where people are willing to throw money just at a wide range of business activities or new technologies. Local governments, I see stress. As offices are vacated, those owners are going to ask for breaks on their taxes. We're already starting to see it. I talked about that. Bottom line, if the U.S. is in recession, our region, because the underpinning government, will do relatively better than the U.S. If the U.S. avoids recession, I expect us to continue to underperform. Job growth, about 30,000 for 2023, dropping down to about 10,000. So I still think that we'll have momentum in the first part of the year, even though job growth turns negative in the latter part of the year. It will still have net year-over-year growth, but understand it's going to be a tale of two halves kind of thing. And then that growth and that slow pace of recovery will continue after that. And with that, I think we're ready to move into the Q&A session.
Thank you, Dr. Clower. A lot of interesting and relevant detail there. We always appreciate your insights. We have quite a few good questions from our attendees. We'll start with one referring to our last meeting, which I believe was last summer, you mentioned that local governments were trying to change zoning laws to accommodate housing demand, specifically high density housing. Has that changed since the November 22nd election? And what do you see happening with local housing developments in areas of opportunity?
Yeah, I don't think there was any real effect on the pattern of that in the last election, but you certainly have a lot of neighborhood opposition to any changes. And then specifically talking about Arlington's proposal of saying that if you have the right size lot and you're near either a bus stop or a transit station, that you could convert your single family lot into as many as 8 housing units. This has been done elsewhere. It's very experimental still, and it has just brought out the folks that are opposed to that. I'll give you an example at our November event. Actually, no, it's an event back in September, I think it was. I worked with our real estate center, and we had a little symposium about this. Brought in some people to talk about the different issues. Afterwards, I had this very nice older lady who came up to me, very polite, very nice. And she said that, she thought we were completely wrong even thinking about supporting such a thing, because she lived in Arlington and she had lived there for 20 years. And what she bought for not just her property, but for the feel of the neighborhood and the way it looked. And I said, fine. And I said, okay, ma'am, so you're telling me that your right to a view shed supersedes the right of your neighbor to do something with their property and to get more money out of it? And she looked at me and said, well, yes. And at that point, end of argument, right? So but what, the thing is that movement, if you think about this, what Arlington is proposing, they're expecting to approve 20 or 30 applications a year. That's not going to change the numbers. That adding 200 housing units to Arlington is not going to change the market and help with affordability issues. The accessory dwelling unit issues that I think we talked about a little bit last year, where you can, rent, having the authority, that has more to do with homeowner associations. Now, Arlington doesn't have that many, but Fairfax elsewhere, that's more of the issue there. But one of the things is that we have to seriously think about what we're going to do. Otherwise, if we don't have more affordable housing available, tell me any reason why any of our young workers, whether they're working for me at CRA or working for you at Matthews Garter or anybody else that are watching today, keep them here when they can take, maybe they take a 15% pay cut for moving to Charlotte, but housing is 25% less.
Right.
It's a hard thing.
Yep. Another question on the job change chart for the metro area. Do you track further detail on job changes, whether they're one related to consolidations or companies moving out of the region, or two, workers who left the region since they can now do the same job from a remote location?
Yeah, we don't have specific data on that, and I'd love to have it. What I would need to get a hold of that would be for the IRS to let me track tax returns. And of course they won't do that for confidentiality reasons, although I do have some colleagues that can get some data for that. I do know, in a conversation that I had with the chief financial officer yesterday in the District of Columbia, that they do have access to some of that data, and they're starting to look at that, about where are workers going, and and are they changing. It's that thing of they're moving, but are they still showing, is the job still here? And so the Bureau of Labor Statistics does 2 different surveys. One is a survey of establishments about what jobs they have. And the other is a household survey. And I tell you what, we're starting, and in fact, some conversations I had with the Secretary of Finance in Virginia, we're starting to look more at that household survey to gauge what's happening because, there is that shift going on. We are seeing people. Interestingly, I had a colleague of mine this morning that told me that what he's finding in his relatively small consulting shop is that he has an employee that leaves. I mean, 20% of his workers fled, to other areas during the pandemic, which meant that all of a sudden he was doing taxes for 5 states instead of 1 state.
Right.
But he has found in the last 2 years that when that person moves to the other city, they're around for 6 to 8 months, and then they leave and go to another job.
Okay. Couple of questions on transportation. I'll just put these two together. How has the Silver Line impacted our region since its opening? And secondly, with respect to I-66, is there any analysis that's either available now and or ongoing as to the residential demographic and employment opportunities and changes since the Silver Line and I-66 express lanes have opened?
So going in order, we certainly, traffic has been pretty decent on the Silver Line so far. I haven't seen the most recent data. I saw some data in December. And of course, what we were really seeing is the most of it is people getting to Dulles Airport. So there's a little bit of trade-off. I would suspect that the Uber and taxi drivers are seeing a reduction in revenue going in, and of course parking revenue at the airport, and how much does the airport rely on that parking revenue. In terms of shifting any real patterns, I don't think we've seen evidence of that yet. It's too soon, but we do anecdotally have evidence of companies, say medium, smaller companies, that are leaving the district and are choosing, maybe to locate out in Loudoun County, Ashburn, something like that, in part because they can, it's a different kind of move to smaller spaces, less expensive spaces. But it's a little early to tell how that's going to shake out. But whether or not it actually changes the direction, what we would like, what some would say is, does it change the direction of commute so that folks could, say, live in the district and then commute to a job out in Loudoun County? But we haven't seen that yet. And the other one, so interestingly, that came up in December 2015, I issued a report that I'd done for VDOT on the economic impacts of the outside the Beltway. And that was actually even an earlier version. So it was like $2.3 billion project. And I think it turned out being a $3 billion. So you had a lot of job creation during the construction phase. Now, our job was not to say what it was going to do about jobs ongoing. Well, there was an ongoing, in the sense that over a 10-year period, if I recall, over about a 30-year period, about $1 billion in economic activity through the operations of those expanded roadways. But that doesn't really trade you down to a particular job. The more important thing is, what are the savings that you would count to the economy because of better traffic flow, less congestion? And that was one where our estimates were saying that, it would save us about $350 million a year in commuter cost, and business costs, because you didn't spend as much time stuck in traffic. Now, having said that, understand that $350 million is a lot, but that represented less than 8% of the total value of lost time that we have in this region due to traffic congestion. Right. And of course, I always remember that what they were projecting for that gave us at what was going on at the time in the growth period of 2015 and all. Looking at that, all of that expansion was going to give us traffic relief that would last somewhere around 7 years, and then we'd be back to the level of traffic that we were before. Now, having said that, since then, hybrid work, slower job growth, it is a little easier to get around, except that if you look at the highway, people may not be going back to the office yet, but they're certainly going someplace.
Speaking of hybrid work, and this is probably our last question, with hybrid work here to stay, how does the area plan to utilize their commercial properties?
Well, if I had the answer to that one, I'd be a rich person, because I'd be investing wisely. Look, we're trying to figure that out, and the National Capital Region Planning Commission is trying to now. I'm bidding on a project with a group to try to help them with forecasting what the federal government is going to need in office space. Mayor Bowser in a speech here recently basically said, we recognize that the federal government may move some people around and may take up less space, but at least if you leave space, leave whole buildings, and then get rid of those buildings so we can put them back on the tax base. Yeah. On the tax rolls, right? So like I was talking about BEA and BLS moving, wherever they are now, at least go ahead and clear out the entire building and then turn that back in for some private development. Right. The problem that we have with it is that there are, in certain ways, you could do structures that would make sense on conversions, but that's not going to work for all of them. And of course, and then we're really concerned about some of the things that the district is doing about talking about blocking off roads, to create pedestrian zones in midday and stuff like that. And you don't want to make it harder to get around the district, however you do it. But and particularly while Metro still can't seem to get their services back on a stable ground. So it's more than our $16,000 question. Quite frankly, that's $1 billion question that we have going on. And we just don't know how it's going to play out. And we still don't know. I think hybrid is here to stay. I think some level remote is here to stay. But you have Jamie Dimon and other people in industry, Elon Musk saying, no, it's not going to be. But I think they will succumb to the demands, that workers are demanding it now.
Right. I think that's it. I don't see any other questions. We certainly want to thank you again for your time today, Dr. Clower. I want to thank each of our participants for being here and participating. And we certainly hope that you will join us again next year.